Imagine you're trying to close like a $100 million M&A deal. It's 2 a.m. on a Saturday. In our current banking system, you are entirely out of luck.
Right. The money simply cannot move until Monday morning.
Exactly. So welcome to today's deep dive. We are examining some sources on tokenized deposits to see how corporate banking is finally fixing that massive liquidity bottleneck. We're going to explore why ditching those slow, siloed ledgers for programmable, round-the-clock digital assets is just a massive aha moment for the future of finance.
It really is. I mean, we are taking the regulated, insured commercial money we all rely on and basically rewriting its underlying physics.
Okay, let's unpack this. We all know the basics of digital money, but tokenized deposits actually take standard FDIC-insured commercial bank money and put it natively on a shared digital ledger. So to visualize this, our traditional systems like Fedwire or Swift basically like a post office that closes on weekends, whereas tokenized deposits act more like instant text messages.
That is a great way to look at it. You can think of the old way as two people trying to update separate, disconnected checkbooks by, mailing letters back and forth. You always have to wait to see if the math matches up at the end of the day.
Right, which is incredibly inefficient.
Very. So tokenized deposits are like moving those separate checkbooks into a single shared Google Doc. Both banks, all parties, are editing the exact same ledger at the exact same time. And that is how we solve your Saturday night M&A problem.
Because the money just lives on that shared ledger natively.
Exactly. That $100 million transfer doesn't need to wait for a Monday morning batch process to clear. It settles in less than 2 seconds, 24 hours a day, 365 days a year.
Wow. Okay, here's where it gets really interesting, though.
Huh.
We are moving from money that simply transfers instantly to money that can actually move itself. These sources detail things called Programmable Money Engines, which embed smart contracts right into the deposit.
And what's fascinating here is how that eliminates manual review. The money itself reacts to verifiably true event data. Like, take the global supply chain, for instance. Say you are buying $10 million worth of microchips from an overseas vendor.
Okay, so under the legacy system, I've got escrow accounts, paper bills of lading, manual customs clearance, just a mountain of paperwork.
The literal mountain, yeah. But with a programmable money engine, you replace all that with interconnected hardware.
Wait, hold on, though. Handing over $10 million to autonomous code sounds like, a security nightmare waiting to happen. How does a piece of software know a physical shipping container actually arrived without a human accountant or lawyer verifying it?
Well, it relies on an IoT barcode scanner at the factory gate. So when that container arrives, the scanner, which is basically just an internet-connected camera, reads a cryptographically signed tag on the shipment.
Oh, I see. So it's hardware verifying physical reality.
Right. The scanner automatically fires off an API signal back to the money engine saying the shipment is physically verified. And then the code just autonomously releases the $10 million to the supplier in milliseconds.
That is wild. The friction just drops entirely. But if money is automatically triggering its own movement, what happens when we're talking about massive institutional asset swaps? Like, how do you prevent one side from defaulting mid-trade if a human isn't holding the funds in escrow?
Well, that requires a shared ledgers and a mechanism called atomic settlement. You will often see this called PVP or DVP in the sources, meaning payment versus payment or delivery versus payment.
Got it. So let's say an asset manager is trading $50 million in tokenized U.S. Treasury bonds for euros.
Right. So normally you wire the euros and just cross your fingers that the bonds show up a day later.
Which obviously carries a ton of principal risk.
Huge risk, yeah. But with atomic settlement on a shared ledger, both the euro tokens and the bond tokens exist in the exact same digital environment. The smart contract mechanically locks both assets simultaneously using cryptographic holds.
Oh, wow. So they swap it literally the exact same moment.
In the exact same millisecond. If party A has the bonds and party B has the euros, the code unlocks and swaps them. But if either side lacks the funds, the hold is released and the transaction simply cancels. The settlement risk mechanically drops to absolute zero.
So what does this all mean then? If cryptographic holds can guarantee zero settlement risk, it feels like legacy, multi-hop messaging systems are living on borrowed time.
They really are. I think the main takeaway for you listening to this is that corporate money is fundamentally shifting from delayed external batch processing to native, always on smart contracts. The infrastructure of global liquidity is being entirely rewired.
Which leaves us with one wild thought to ponder. If money can now use connected IoT scanners to verify its own delivery and lock itself in cryptographic holes to execute multi-million-dollar trades instantly, well, How long until human corporate treasury departments are completely managed by autonomous code?